Robschild. No investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, January 22nd, 2025. Today's episode begins discussing the U.S. leading index. It came out officially at negative 0.1%, which is exactly what had been predicted. It's what markets were expecting. If we go to the press release itself, conference-board.org, for this report, the Conference Board Leading Economic Index, LEI, for the U.S. This is the report here, decreased in December. I wanted to bring up that it was revised upward from, I believe it was 0.2% in November to 0.4%. I found it interesting. Part of this report states the LEI is no longer signaling a risk of recession. The idea being that when the blue line is below this line here that's kind of spotted in black, then that's their recession signal. Notably, according to this signal, during that stock market correction of in 2022, the recession signal was red that entire time. And on the same chart during those previous times where it was red, well, first of all, this went a lot deeper. At least this metric here, the LEI 6-month growth rate percentage annualized. So that's it. We're out of the woods. The soft landing has been achieved. Good job, everybody. Except it's not exactly like that. Not the way that I see it. An interactive chart version of this from tradingeconomics.com has this, and as I've brought up many times in the show, this is just going down and down and down and down. And for some reason, this is 99.5 and 99.7. I found another source also from ceicdata.com showing these numbers to be above 102, but it's supposed to be the same data. But the point is, even on the conference board website themselves, the point is that the line is going down, and every time in the past it goes down, there's a recession there, and we don't have a recession yet, and it's still pointed down. Again, I'm looking for sort of a pause and then a high and then a higher low. Like, I want to see it going this way before I can safely say that maybe we actually aren't headed into a recession anymore. As it stands, I think that we still are headed into a recession, or as I've been saying on the show a lot, maybe even a really bad depression. But that's just me and my crystal ball. Next agenda item, SPX, otherwise known as the S&P 500, just hit a double top at 6,181 cents. We'll get to that chart in a moment. Before that, here are the daily reminders. Not really any changes. Watch Macro Update 110.25 with dominoes in the ball to hear me read through these very important items. In that show, I also read through my crystal ball readings and explain my own personal portfolio. So watch that show to hear me walk through it. The first of the 4 charts that I'm interested in discussing today is the SPX, the S&P 500, hitting that all-time high. Breaking through it a little bit, just a tiny bit. The previous high officially didn't even get to actually 6,100. It was 6099.97, 3 cents away from the 6,100 level that a lot of people have been expecting based on a logarithmic chart of the S&P 500 going back from the 1929 top bubble to the dot-com top bubble to the post-COVID AI magnificent pre-magnificent depression bubble is what I'm going to call it. We hit it today. So now chartists are sort of looking for, are we going to stay in this range and fight here? Because then that would be clearly a bull flag that would indicate that the most probable move would be to the upside. So if we stay here for 2, 3, 4 days and in this range trying to get above, it will be hard to get above this level. It should be anyway. I'm not going to say I'm going to eat my own hat on this one because Mr. Market can really do anything, but it would be highly unusual to just surge right through this. We'll at least expect a battle here and then maybe a breakout to the upside. The other way that I can see this playing out is having this play out like a blow off top where this move is just strongly rejected and we go down just as fast as we went up. Another chart that caught my eye today is DXY, the dollar index. I talked about how it no longer is looking obviously bullish anymore, and that's becoming more and more evident after a large red candle like this and moving sideways at the bottom of the candle. This is clearly a bear flag, so the most probable movement is actually for the dollar to break lower. This is while gold is still heading higher. I'm not going to bring that chart up today, but it's bullish. Gold is still going up, maybe to form a double top of its own, maybe to surge higher to the psychological $3,000 levels. We'll see what happens on that. TNX, the 10-year treasury yield, I said yesterday, looks like it might be forming a head and shoulders top. It is still forming pretty much exactly as I sort of was seeing in my crystal ball and all. We bounced right off of yesterday to the upside, and so it would be very not unexpected for this to play out. This is especially because oil is continuing to the downside here. We had a blow off top here, and so if the rest of the market follows oil with this blow off top here, and the 10-year note yield never actually getting up to that 5% level that people were expecting, yeah, it's the season for blow off tops. That's what I see in my crystal ball and all. And that's all from my crystal ball and all. Thank you for watching. Hope you enjoyed, and see you next time. Robschild.